We are live now, so I'm going to kick it off. Good afternoon, everyone. I'm Brandon Martin from Columbia Business School's Energy and Infrastructure Club. We're very excited to be kicking off this panel today, which will be moderated by Professor Daniel Nocera from Harvard, who's a leading researcher within renewable energy. Today, he'll be joined by Daniel Carter from Saudi Aramco Ventures, Kelly Metcalf from NCAP's Energy Transition Fund, and Ahmad Faisal, Managing Director from Marathon Capital. Today, they'll be focusing the discussion on investors shifting their focus towards energy transition. As we go along, please post any questions that you'd like the team to address in the chat on the right-hand side, and we'll address those within the last 15 minutes of the conversation. And now, Professor Nocera, I'll kick it over to you to kick off the discussion.
Okay, before I do that, maybe I'll go through the panel in just a few lines of what you do and your interests. So I'll start, I'm just looking at my panel here, so I'm taking from top to bottom. Dan, could you just tell the audience what you do and some of in your interests?
Yeah, great. And just as a sound check, Dan, can you hear me?
Yes.
Okay, great.
The most asked question in Zoom calls. Can you hear me and can you see my presentation?
Yeah, I got to always start that way. So I'm very happy to be here. Thank you for inviting me. I'm a CBS alum and the sort of a current, I guess, president of the Houston Club. That's why I had the Warren thing, which was a little thing that the Alumni Relations gave to us a little while ago for in-person events when they existed. So I'm with the venture capital side of Saudi Aramco. Aramco being the oil major. I work for what's called Saudi Aramco Energy Ventures, the venture unit. So I'm authorized to speak on behalf of SAEV and not on behalf of Aramco at large. So as questions, if they should emerge and they're really about Saudi Aramco, I'm not authorized, but I'm also probably not qualified to talk about that. I'm really a practitioner in the venture capital business. We have 3 buckets. It's all Aramco funding, which is also different from PIF, the Sovereign Wealth Fund. We manage Saudi Aramco Energy Ventures is the strategic fund, just so you could imagine, and we'll get into kind of what we do and why we do it, but it's basically focused on improving the business of Aramco. We're an investor in OGCI, the Oil and Gas Climate Initiative. So we've allocated $100 million out of the billion plus venture fund there. That fund is managed separately by a separate team, and it's about carbon emissions reduction, efficiency, and methane emissions. And then the third bucket, which may or may not be relevant for energy transition, is a new vehicle called Prosperity 7, which is really diversification options outside of energy, looking at broader tech capabilities. So I straddle both of those. I've been on 9 of the 24 boards seats that we've had in North American investments, and kind of splitting my time between Prosperity 7 and SAEV. So yeah, happy to be here. Thank you.
Okay, thanks, Dan. And now Kelly.
Good afternoon, everyone. Hi, thanks for inviting me to join. As Brandon mentioned, I'm a managing partner with NCAP's Energy Transition Fund. NCAP Investments, we're out of Houston. We've been around for about 32 years, have invested about $38 billion, and private equity firm, and have 22 funds. Started out as upstream. The founders of NCAP started out as upstream investors. Then about 12 years ago, they moved into the midstream space. And NCAP's model is not to take upstream investors and turn them into midstream investors or then turn them into energy transition investors, but rather to go out and find teams that have real expertise in that field. So about 12 years ago, brought in a midstream fund. It's called NCAP Flat Rock Partners. And they manage the midstream business for us. And then about 2 years ago, my partners and I joined NCAP to lead the energy transition efforts. So we're just finalizing our Fund 1 fundraise. Currently, we have 5 portfolio companies. So we invest in large development type companies our investments are portfolio companies. So we get the best teams from our experience in the industry and from our industry and the people in the industry. Create the best teams who then create a development platform and operating platform. And we combine those aspects of the business and sell the whole business in a liquidity event to a lower cost of capital buyer. So some of the investments we have now, front of the meter battery storage companies, we have two of those companies. One's called Broadreach and one's called Jupiter Power. And we have a distributed C&I solar and storage company. And typically we make commitments to our companies between somewhere between $200 and $300 million commitment to each company, and have a hold period of anywhere from 3 to 5 years, but there's flexibility around that as well. Again, thanks for having me. Look forward to the discussion.
Thank you, Kelly. And Ahmed?
Thank you, Dan. So my name is Ahmad Faisal. I'm a Senior Managing Director at Marathon Capital, which is a boutique investment bank focused on sustainable technologies, energy and infrastructure. Unlike everyone else now, we were focused on renewable energy and sustainable technologies long before it was fashionable. Our firm is over 20 years old, and there's about 70 of us now. 5 years ago, there was only 25, but I think it gives you a sense of how much interest is in this area. We're about 70 investment bankers, headquartered in Chicago, office in New York, office on the West Coast, and we have presence in Latin America, Europe, and Canada as well. I joined Marathon about 6 years ago, driven primarily by the realization that the next 15, 20 years, if you were to be an investment banker, the area where you could make green, both money-wise as well as a cleaning up the world, this was going to be one for sea change, transformative opportunity. And so I joined about 6 years ago. Prior to that, I was with Bank of America, Merrill Lynch, and Citigroup. And back then I was working on coal plants and natural gas plants, but now it's very different. Everyone is within Marathon has been focused on this space, but we're happy to see that the big banks are also heavily focused on this. And we certainly feel like we're at the start of what will be a very exciting 15, 20 years in this space.
Okay, thank you. And I'll just introduce myself quickly. I'm Dan Nocera. I'm the Patterson Rockwood Professor of Energy at Harvard. I invented this thing called the artificial leaf and then the bionic leaf. I started a company called Sun Catalytics that was acquired by Lockheed Martin, and now 30 miles north of here in Boston, the largest flow battery is being built based on Sun Catalytics. And now I have another company called Kula Bio, which is a distributed food and energy company. You can generate combining basically physical energy generation with biological energy generation. So I've dealt with a lot of the investment, but from the smaller side, not the mega side, which at some probably more with the Daniels of the world than Ahmed and Kelly's of the world. But we have a diverse audience here today listening. And so I wanted to start off with a general question from each of your perspectives. It's really nice that we have three very different perspectives in investment. And what do you see as the shift in the primary for private investors to start focusing on energy transition into 2020, 2021? So maybe I'll start off with Daniel, and from your end, Daniel, what are you seeing as a shift that in your life as being part of an oil company that's driving energy transition? Oh, Daniel, I think you're on mute. Sorry.
Okay. From from an institutional investor's perspective, not my perspective, but my shareholders' perspective, we're public company listed on the Saudi Stock Exchange. I think kind of long tail risk events that were not visceral became kind of visceral with COVID, and the idea that sort of systematic risk that's not really, it's sort of so external that it's kind of hard to conceptualize, has become kind of more real for a lot of institutional investors, right, or allocators. I think that's one aspect of it. You've seen a very big dislocation in fuel markets, particularly jet fuel, and so there's definitely been some big moves that have impacted different companies differently. I think the share price for Aramco is actually up from COVID. We've maintained our dividend. I think there have been other companies in the sector that have not been able to maintain the dividend, maintain the growth, that have gone down. You could look at that sort of as a basket, maybe 40%. So I think that for us, it's been a topic for a long time. ESG has been a topic for a long time for Aramco. But for us, looking at investment opportunities in the tech sector that address ESG sustainability is something we've been doing for a while. We've got several investments in the space, particularly bulk electricity storage. So our investor in Form Energy, we're close to making another investment in bulk electricity storage that we may fund next week. And we've got a solar investment. In terms of the broad-reaching efficiency, you've got this large topic that me and my peer group, think about Shell Ventures, Chevron Ventures, BP Ventures, and so on down the line, are interested in digitization, right? So bringing machine learning, bringing edge compute, bringing intelligence into sort of non-responsive, monolithic, old legacy assets to make the oil patch cleaner, more responsive, more flexible, more uptime, and et cetera, right? So I think digitization is kind of an overlying topic that we've done so much. One thing that we do a lot of that I'm not sure how many of the other oil majors do is cybersecurity. So we've done 5 cybersecurity investments in the past 18 months. We are a great reference customer. You can imagine that the parent company I work for is the subject of regular state actor attack attempts. And so to be able to have that reference is very valuable for cybersecurity companies. And also we've got a quite, as you can imagine, switched on department in that area. So that's been a really neat collaboration that's outside of the particular topic of energy transition, but I think it's in line with a broad technology shift across a variety of cloud compute, machine learning kind of swooping through all industries, and software being a major competence and component for all businesses, including energy. I think that's part of our story.
Yeah. Just one quick question, follow up. I know you don't want to be a psychologist for your shareholders, but you talked about an externality that nobody could imagine, COVID, and it's really shook their foundations. What do you think the memory effect is? Is it here to stay as a memory effect, or by next year, once we're all back to normal, people will forget about it, and that sort of forward-looking investments, let's say concern or anxiety, will it go away, or do you think it's really here to stay?
I'll give you my personal view. I think it's here to stay, and I'm not sure which parts are here to stay and which would go away. I'm talking to you from Houston, and I am livid about the market rules that Texas has on power, power trading and the ERCOT rules. I don't know which party is to blame per se, but I was without power for 4 days. Water, heat, and temperatures got down to below 40 degrees in my house, and I have 2 little kids that I'm trying to take care of. So, I will remember that for a long time, and I'll remember the way Texas thinks about, unregulated markets without FERC intervention for a long time. That's my personal view. It's got nothing to do with Aramco. Yeah. So I think when you have these shock moments, it sticks with you for a long time. And so I think we'll see how the different parts of the investor community, be it institutional allocators, venture funds, private equity or infrastructure funds, how they respond over a long time. Time will tell.
And going to another Houstonite, Kelly, What do you see as a primary driver for that, for a shift to an energy transition in your business?
Well, I mean, we've been in our first fundraise with the Energy Transition Fund here at NCAP for the last 18 months. And so it's really been interesting to see as we started, one, NCAP, people didn't traditionally think of us as energy transition. And so a lot of the limited partners with whom we work weren't invested in that space, but at the same time, they were getting mandates, internal mandates, that no more upstream investments, no more carbon-based investments. So there was interest, but when we started fundraising about 18 months ago, we got a lot of, renewables. We're interested in that, but we don't really know what it means. We want to track, we want to, we want you to come talk to us, but we don't know what we're doing in that arena yet. And over this 18 months, it's been incredible because one was COVID. So obviously, as anyone who's been in a fundraise knows, COVID slowed us down. We couldn't go out and meet with people and do a lot of the relationship building and explanation of our strategies that is helpful when you're raising a fund. But we've seen just the pickup and the speed here at the end of our fundraise that's been incredible, and people that have moved from what is renewables to I definitely want to do renewables. And I think there's also, so that's the last, call it 2 years, change in view on energy transition. And a lot of the early, 2 years ago, there was a bad taste in people's mouth from the last go round, from renewables in 2010, a lot of limited partners, especially the progressive limited partners. So you have the coast, California and New York, and those limited partners were first in, and there was a lot of money, frankly, lost on renewables, that in that period, 10 years or even before that. And so getting out of that mindset of what renewables are and return profiles and where renewables investments what they could turn into, we've seen that shift, and it's tremendous now to see at this point in time, and I think everyone who's viewing now knows this as well, ESG is the hot topic, and energy transition within the ESG format is very popular now, and so I don't think I've had over a 25-year career going from trading electricity and run up to where I am now, and I haven't seen anything move this quickly as we're seeing investment in both energy transition and the ESG space.
Kelly, in terms of the ESG space, what do you see as the primary challenge then as people shift to a clean energy focus on their investment? What do you see at your end as the big challenge there for this change in portfolio to ESG?
Well, for us, I mean, we're clearly within that mandate, and so for the NCAP's Energy Transition Fund, it's not necessarily a change for us. It's interesting to see we're in the private equity realm, and if you look at private equity returns from upstream, where I think the market realizes that's kind of a 22 to 27% type return profile. I think investors have had to say, well, wait a minute, not all renewables or energy transition are going to fit into that same paradigm of private equity returns. So you get into a lot of companies that want ESG investment, but I think they also need to look at how, from at least a private equity perspective, the return profiles can be different. They're still good returns, but they're not like some of the upstream returns that people had seen in the past.
Yeah. And Ahmed, so as an investment banker, you put huge deals together too. What do you see as the primary driver for the shift in your business?
Yeah, so I mean, I think I think first of all, it's probably helpful to take a step back, right? I mean, 25 years ago, if you went back to the investing community and say, hey, you'll have to spend more money to do this investment versus the other, and the reason you'll spend more money and be okay with lower returns is because it'll make the world greener. I mean, you would get laughed at, right? I mean, that was just a mentality that didn't exist, right? And so fast forward to today, I mean, it's just totally different now, right? I mean, like, you have pressure from whether that's the LPs or the public shareholders or the boards, that look, you have to be in ESG, you have to be in renewables, so I think it's, yes, we should talk about what's changed in the last year and a half, but it's much more important to remember how much change has already taken place, and to Kelly's point, how quickly it has happened. Right. I mean, like, and we're still at the start of this. I mean, if you look at the renewable energy space and, how much, private capital is dedicated to it versus the overall energy landscape, I mean, it's 5% tops. Right. And so, it may feel like that the renewable energy, private, whether it's private equity or infrastructure fund or the private capital in general is small. Yeah, it's true, but it's not because people are not interested. It's just because renewables as a overall, asset class is small. I mean, if you look at, and then you kind of marry up that conversation to what's happened in the last year. I mean, look at how, some of the clean energy ETFs have performed. Yes, I mean, everything is up, and S&P is up about 25% or so, but the clean energy ETFs is up over 100%. You look at how much capital has been raised that by funds dedicated purely to ESG, loosely defined as clean technology renewables. That's over 125 billion. Most of that is in the U.S. And then about 75 billion of it, 50 billion in Europe. The number of funds raised in Europe are actually more than the number raised in the U.S. But that's for a couple other reasons. But point being is that, COVID has accelerated in some ways, the focus on ESG. But there's no denying that a sea change has already occurred from where we were 20 years ago.
Yeah, I think, I remember when I started my career, I've been in energy my whole life. I would have to explain why people should be worried about an energy transition. And the really big shift is, a lot of people here are listening, they've grown up with it. And I always say, even 20 years ago, if I turned to my left or right and said, what do you think about energy? I probably would hear silence. People wouldn't think about it. Now, I can talk to anybody. I don't care if it's somebody that's doing, trash reclamation or a student. They have an opinion about energy. And the young people are now growing up with that as a benchmark in their life. And I think that's what's actually really driving this transition.
Can I piggyback off of that, Dan?
Yeah, sure.
Comment. Dan. So I think, energy transition to low carbon is one, and the energy transition towards digitization is the other. And so, an effect you had with COVID was a requirement for digitization, right? Remote management, understanding your assets, and being able to, do processes on a more automated basis. The more you take people out of the process, the more you have human error removed from a process. So, that was required by COVID on the one hand. On the other hand, you have such massive hits to, cash flow of oil majors, you're going to have major layoffs. And so I think particularly the peer group had significant layoffs. And so sometimes that comes to more expensive people. And there's something in the oil and gas business called the crew change, which is basically people who are over 50 years old. They kind of come through in waves, depending on sort of the price of oil. People go into petroleum engineering programs in big waves, depending on when. So a lot of the kind of older people who had positions of responsibility are cycling out, and that really accelerated to some extent with COVID, which means you've got people maybe late 30s and 40s who grew up with a more digital kind of approach to doing everything, from personal life to enterprise. And so now you've got decision makers who are not in their 60s, who are not used to doing things by hand, who are really amenable to digitization. So those are two things that are sort of sweeping the industry in parallel to the energy transition you're talking about as well.
Yeah. So much of it is a social culture that drives all these things.
Yeah.
So, maybe playing off on this, in 2010, I think Kelly mentioned this, there was lots of excitement, and then it all sort of dissipated, especially when people saw a lot of this energy transition is going up against the legacy infrastructure, which is a high CapEx, and a lot of it has been paid off. And then all of a sudden you're trying to do an energy transition into a legacy infrastructure. And a lot of the investors just with the, an ROI in mind, that just died quickly. Is it going to die again, or is it here to stay? And what do you think is different if it's here to stay? Maybe Kelly, I'll start with you on that since you brought that up.
Yeah, absolutely. I do think it's here to stay. I mean, we've seen a dramatic change in the world and move to decarbonization, and I don't see that going backward. If you look at 2010, you saw a lot of investment, a lot of technological and operating risk type investments when they were doing biofuel plants and bringing in palm oil, which now you can't do palm oil. And a lot of that was risk that wasn't understood by the investors who were providing capital. And now, I mean, in our first fund, we specifically said we're not taking technological risk. I mean, the portfolio companies we have are doing down the fairway battery storage, down the fairway solar and storage, and no technological risk. Just given where we are now in the requirements and both, there's also political and regulatory, and I think it might have been Ahmad who mentioned it, even more so in Europe, right? And the US is going to have to move forward, whether it's pricing of carbon or national RPS, things along those lines. But regardless of that, we've made a shift, and it's moving forward. And we've seen that things like electrical vehicles work. They're not prototypes anymore. Now we need to get the EV charging out there and make it more accessible. We need to get range out there on the EVs. But these are no longer prototype type industries. They're the real deal, and the shift is happening.
Yeah. I do want to say though, people, there is risk. If you bring in 4 Teslas into one supercharged station, you're going to wipe out that local ISO. So there's real infrastructure challenges still ahead of us. It's because it's really low penetration. I think people are underestimating what they're going to be up against at high penetration. And
I agree with that, Dan.
Yeah.
So Dan, if I could also, answer your question. I mean, look, I mean, the train has left the station. I mean, I don't think it's a question of is this going to go back to the old way, and is it going to be like 2010? I mean, just think about 2010, right? So 2010, the levelized cost of electricity in the power, from using power rule terminology. I mean, like wind and solar were heavily dependent on federal tax incentives, right? And as anyone Kelly, as anyone that's been in that industry, and any industry at the start, you do need favorable policy, you do need incentives, because at the start of any industry, and especially the type of industry we're talking about potentially changing the world, you need incentives, right? And we had the PTC come and go, and and that created a lot of what I would say unnatural hiccups, and it actually in some way blunted the growth and the natural transition of the industry to much bigger. Fast forward to today, I mean, in most of America, the cost the LCOE of solar is actually lower than natural gas, and this is at natural gas at the lowest it's ever been, close to the lowest it's ever been, right? And why did that happen? Well, the cost of solar fell by about 90% over the last 10 years. The cost of wind fell by almost 50%. And so things are happening faster than people thought. And in most new industries, like, if you hit your moonshot or if you hit your projections, people are like, wow, that actually happened. Like in wind and solar, they've actually passed it, right? And so things are very different now. This is no longer like an experiment pet project. I mean, this is actually an economically better proposition. I mean, coal plants. People have said this again at many other places. I'll say it. I don't think we'll have another coal plant built in the U.S. ever again, right? And coal supplies about 40% of electricity in America. 20 years ago, coal was majority of electricity produced in America. So just think about the sea change that has already happened. The train has left the station.
Well, I'm glad. I think a lot of people listening will be happy to hear that. Dan?
So yeah, Kelly, when you were speaking, I turned off my camera for a second to pull a book from my bookshelf that I think Dan Nacera will recognize as an old classic, experience, right? And it's dated 2000, right? So this is a 21-year-old book that's sitting on my shelf that shows how long we've been at it. Shows the experience curves, from, they're vastly understated, right? But I think, that just sort of, back in, and I'll reference venture capital because I think that's kind of where I'm coming from. Back in kind of 2005, 6, 7, you had a number of Silicon Valley, really successful, venture capitalists who said, okay, look, we care about climate change. We want to make a difference, and we're good at building companies. We're going to, do this and have this wave of clean tech venture capital investing. And, many of them really had no experience whatsoever with energy markets, or physical markets, building consumer facing internet, is not necessarily the best analog for physical power or oil and gas delivery. So I think, a lot of bets were made, a lot of money was spent, scale up risk issues and, lack of industry experience issues. In the meantime, we've come down this cost curve massively, as Kelly and Ahmad have explained and is explained 20 years ago. We also have, cloud compute, which makes it so much cheaper and faster to start a company. We have, 5G's rolling out. You've got IoT sensors and analytic packages that make it so much easier to get insights and actually action insights, right? So all of these things are new since the last wave of kind of, venture investing in 5, 6, and 7 by the major funds on the West Coast and some on the East Coast, and also just lessons learned of what worked and what didn't work, right? Mm-hmm. So I think it's completely different in terms of tools available for entrepreneurs, and just where we're at in terms of experience curves and underlying tech mega trends that enable a lot of these businesses to just grow so much faster and easier.
Yeah. This is a general question, but imagine you have you're Aladdin. You had a wish for investment in energy transition. What would your biggest wish be? I'll give you an example. One thing I saw is you have political parties coming in and out, and it's from an investor point of view. It's up, it's down. I've always just thought if somebody, and I don't think we should get into policy, but if there was some type of measure of predictability for an energy transition market, politically or policy-wise, that would really accelerate, at least from my end, investment. But for each one of you, what would your biggest wish be to de-risk your investment from your perspective in each of your businesses? I'll start with Kelly again.
Yeah, well, it's hard to, Dan, you said, let's not go to the policy realm, but I think you somewhat have to. On large scale renewable or energy transition, Ahmad was referencing this, I think we need to do away with the production tax credit, investment tax credit. There's just a perversity to the market and a haves and a have-not in that doesn't work. There's a couple really big providers of tax equity, and they have preferred clients with whom they work. And so you create just an unlevel playing field that's not really helpful to the long-term longevity of renewable projects. So that, and then consistency in underlying market rules. So sure. This is all, I'm talking just US based at this point, but just consistency. I mean, we had the minimum offer price issue in PJM that was a big constraint for renewable wind and solar projects. Now we've got, as Dan was mentioning, this whole Texas phenomenon. What's going to happen with the market rules there creates a lot of uncertainty that makes it difficult for investors to come in. So I think really those two things, and when you're looking at U.S., would be my Aladdin's lamp wish.
Okay.
If you don't mind, next. You said really an Aladdin's lamp, so a true wish that will never happen, right? So this is a true wish that's not policy oriented. I wish that incumbents did not obstruct and try to crush startup companies who have actually better solutions that society could be better served by, both in terms of sustainability and economics. And so, a couple of examples. Imagine that you're a distributor, or that you're a major OEM of some particular type of power gen equipment, and you've got a distribution network where you require certain practices and OEM parts to be used, even if a drop-in replacement part would increase efficiency massively. That person cannot sell through that channel, and they just can't get market traction. Imagine you're a catalyst company. This may or may not have happened to me. One of the big catalyst companies for refining, you've got this amazing new catalyst that's environmentally far better because the conversion rates are far better. So you don't have to, drill as much oil out of the ground to get the same amount of product. And, you have global pricing contracts where if some volume comes out of a system, the entire system's pricing goes up. So you've got to actually make good for the entire system's economics just by getting into your first unit to show how much better you are. Another thing that may or may not have happened to me is, imagine a situation where you're just doing a hybridization of diesel gensets in off-grid areas for telecom towers in Africa. You can cut the diesel spend by 70% on volume basis. And some of that stuff's very expensive to deliver. Sometimes it's delivered under armed escort because of the value of the fuel. And you have the local incumbent company, family owned, literally deliver services for free for a period of time to make sure that that new technology does not get in there. So it's a true wish, but I mean, it would be great if incumbents would have a fair playing field for new entrants. Won't happen, but it's certainly, the whole misattributed quote to Gandhi about, first you ignore them, then you laugh at them, then you criticize them, and then you win, right? It happens. That's my daily life, when it comes to getting new technologies into incumbent markets. So that's a wish.
Yeah, this legacy issue. I think that is also a big
legacy issue. It's a market practice behavior, anti-competitive, deliberate blocking behavior on behalf of large incumbents is what I'm talking about.
Yeah. Ahmed, you were going to say something.
Well, I mean, my wish is going to be much simpler, which is just keep policy consistent. Honestly, policy is good at the start when any industry is in the infancy and it's an important industry. But I think to Kelly's point, we've grown that point, and so just keep it simple. Let the market figure it out. Let the capital figure it out.
We're coming up to 15 minutes to go, and I want to take some questions from participants, but I see one question, and before I go to that question, I was going to ask a more general question. What types of technologies, or I'll even say investment or financial tools, are you most excited about going forward? I'll start with Daniel. You see a lot of technologies. What do you see as most exciting? And I'll move to the other panel members.
Well, I'll tell you what I'm curious about. And I don't know if it's the most impactful, but I'm just really interested. You can call it carbon accounting. You can call it, know your footprint. But I'm just waiting to see, is there a company that's got a great and scalable solution that can quantify what's your scope 1, 2, and 3 footprint? And, is that a marketplace of information and data that can be sold to institutional investors for, owners of liquid securities and also for companies to know and be able to sort of prioritize improvement of their footprint? those kinds of platforms can be very valuable if they're not stuck in one industry. So we're seeing plays that are working on that for oil and gas or for a different industry. But if there's one that kind of cross-cuts but is meaningful, that would be interesting to see. It'd be also interesting to see what's the survivability of that kind of a carbon accounting or ESG accounting, because it feels like all sectors and all companies need to understand their scope 1, 2, and 3 very quickly and take action. So it feels like there's a really unmet need on behalf of both institutional investors and on behalf of corporates. So we're seeing deal flow. If you see stuff that's interesting, send it my way, because I'm very curious about how that space is going to develop.
Okay. Ahmed? What you're most excited
from my
about
perspective,
looking down the road near term?
Yeah, I mean, from my perspective, it is, I grew up, outside of renewables, right? I grew up in the coal and the gas industry, which is in my past now. But I mean, for the energy and power sector, the holy grail is always, how can you produce power that you don't have to use immediately, which is storage. And so, and there's a ton of progress that's been made in that area as well. Costs have come down dramatically. But, I think for me, it's storage, because if you figure out how to have, utility scale, like massive storage, but in, obviously, within a contained size, I mean, that really just, just think about how much, power plants we need in America, and how much inefficiency there is, right? Because we can't store power. So for me, storage. I mean, I think the other thing that really gets me excited about the future, and our company Marathon has been doing quite a bit in the space, and Kelly mentioned as well, is distributed generation. I mean, for example, the issue that was mentioned in Texas, if we had microgrids or distributed generation, probably a lot of the problems that we saw could have been avoided. And I think in both of those, storage and distributed generation, and microgrids, there's a lot of work and a lot of innovation remaining. I mean, wind and solar, I know it sounds funny saying, but they're mature. They're kind of not new industries anymore.
Yeah, I'll tell you one funny story. Many years ago, people would always say, where do you see the big sea change? And I would say distributed. And when you see the nuclear industry talking about local reactors in the ground going distributed, that says it all. The world's headed to a distributed world. I don't know when we're going to get there, but once you see nuclear going to basically citywide nuclear buried in the ground sort of ideas, whether it happens or not, distributed is coming down the road, and I do believe that. And I want to get to one other point that's later about the poor, because for going to that part of the world, it's going to have to be distributed. Kelly, what are you most excited about?
Yeah, but what I'm most excited about dovetails actually with what Ahmad was speaking about. We say that solar and wind are mature, but if you look at how much more solar and wind are going to be deployed, it's billions and billions of dollars, and hundreds of gigawatts across the world. And what you need to go with that is storage. One, we have both a wind and a separate solar development company. So we think that both of those businesses continue to grow in a very big way, both in the US and globally. But we also think storage, and what does that storage look like? How do you combine wind and solar together with one interconnect, with one large storage facility? And then how do you take the grid? How do EVs play into that, if you will? Are they storage devices on the grid? What would that have done in the Texas market during this last winter event that we had? So it's really, I guess it's the continuation of solar and wind with battery storage, or hydrogen is also, right, a way to store. So that's exciting. And And I do think it moves more quickly. I mean, we saw it with battery storage and the cost curve come down so much more quickly than anyone thought. People talk about hydrogen being economic in 2030. I think it's going to be a lot quicker than that as well. So it's really, it's an amazingly exciting time to be in this space.
Yep, the hydrogen has the infrastructure challenge, but
Yep.
from a technology generation point of view, it's going to happen very quickly. So I was asking that question to set up a question from Les, who asked, what types of deals or technologies are not that you aren't seeing that you wish you were seeing? So it's not what you're most excited about, but maybe something that you haven't, it's obvious, you haven't seen it, and you wish you were seeing it. Is there any technology or deal that fits that category?
I mean, that's a good question. I mean, it's. I mean, I was sad when Concorde went away, I guess. So I guess, I mean, that's what I'm kind of thinking about. Like, what type of thing? What type of technology? I guess should have been more successful, but is not. I mean, that's a really tough question. To be honest, I never really thought about that. And maybe it is because there's just so much innovation and new things happening in the renewable and clean tech space that we're like every day there's a new type of deal on my desk.
Yeah.
But I don't know. I'm struggling with that question. Let me think about it. Maybe.
Yeah. From an NCAP perspective, I was going to say, we put teams together. So if we see a certain area of the market, that storage is a good example. We actually put together the broad reach team to tackle storage, front of the meter battery storage. So, I mean, when we see the opportunity, we put a team together. We don't necessarily wait for either the team or the technology to come to us. I mean, we've looked at 100 different, 100 and plus opportunities for our Fund 1. So we really are in the business of building teams and businesses to attack what we see as potentially the next wave or continuation of a current wave like solar and wind.
Mm-hmm. Maybe, go ahead, Dan.
No, I was just going to say, from the venture perspective, we've got one strategy, right? It was articulated by an entrepreneur that I had met. I've been doing this since 2003, a long time ago, who said, I asked him, what's his strategy? And he said, start small, grow big. He had a 4-word strategy. That's all we do, right? We grow products, we grow revenue. With folks like NCAP, you've got all sorts of strategies at your disposal. All we do is grow in terms of, grow top line and grow adoption. So the way that I interpreted that question is a little bit like, well, what's the unmet market need? What are you not seeing that's not met? And I think that there's a ton of individual items that are not met. One tricky bit about incumbent energy markets, and I'm not an electricity kind of type of investor, it's more like oil and gas, is that, the difference between the TAM, the SAM, and the SOM is massive, right? So like, what is actually serviceable, obtainable market compared to the big TAM? And what's the go-to-market strategy? And how do you sell it? And what's the sales cycle take in terms of people, time? How many people do you need to hug to complete a sale? These are like really important questions when you're thinking about like, well, what am I seeing that what's the unmet need here? So I think that's the way I'm thinking about it. And there's a whole variety, right? Just like, because the energy sector's got so many, significant subsegments in it that have varying challenge to penetrate if you're a newcomer. Yeah, that's what it is.
There's a question I was wondering about. What do you look for in a deal, a transaction, or a venture? What's most important to you? Like, for instance, I'll give you a few. Is it an exit strategy, or what big flag do you see? Because there's a lot of people here listening and interested in this. So what's sort of some of the nuggets you really look for in your business, whether it's a deal, a transaction, or a venture? And what matters to you, I guess, simply put. Kelly.
Yeah, the biggest thing for us, and it's across the NCAP from our upstream, midstream, and the transition fund. It's the team. It's the people. So we have to know the people that we're investing in, and the team that we're investing in needs to know one another and have been working together. We find that to be investing in good people and good teams is the way to have consistent returns in this business.
Okay, Dan?
I mean, for sure team, right? For sure team. Also, I sort of, the last question I answered about, actual market size, not the fictive, large market, but what's the go-to-market? What's the addressable, obtainable? So market is really challenging in a lot of, that looks great on paper, but how do you sell it? Purchasing behaviors, time, when you've got a ticking clock and, you're backed by expensive venture dollars. That's really important. And also then, like, what difference does it make? Like when you get, a new business implemented, what's the world look like? How big is it and what changes? I think that those are important, kind of more philosophical questions to answer. But it's really market and team, and obviously the I guess you could say, 3 questions, right? Is it worth doing? Can they do it? And then the third question, it's sort of like a sort of an ancillary question. Why now? So I mean, if you can answer like, is it worth doing? Can they do it? And why now? You're, pretty far along on your investment decision-making process, in my opinion.
Okay. Ahmed?
Yeah, I think from my perspective, I mean, I'll maybe break down that question into 2 parts. One is, because the renewable energy industry is, yes, I mean, it's a team industry. It's developers, it's platforms that are out to try to raise capital for whatever great idea they have. And, that requires a vision, that requires a team, that requires being bold and frankly, be okay to make mistakes, right? And so, you need the vision when you're thinking about new and brand new things. But I think that's the first part of the question. So I guess I'll say team. But on the other side, it's if you look at the private capital, because I think what our topic was to talk about the private investors. I mean, most of the private investors that have activated, enabled the renewable energy industry are folks that range all the way from a PE fund on one side, but all the way from a pension fund on the opposite side of the spectrum, right? And so on the pension side and the infrastructure fund side, I mean, you're just looking for longevity of cash flows, right? And so, I think and so you're looking for, we talk about returns, right? Yes, it's not going to be possible to make 20+% returns on wind and solar, but it's also unless you have derivatives to blow things up, like it happened in Texas, you're not also going to bankrupt a wind farm. You know why? Because a wind farm doesn't need anything to run except for the wind. And so it's, I think so. That's what I would say is that, the quality of the asset and the quality of the team that built it for folks like infrastructure funds and pension funds that just want to hold the asset for 30, 40 years. But when it's come to new technologies, new development, then it has to be the team. It has to be the vision. It has to be ability to not be scared.
I just add one more thing. In addition to everything that Kelly and Ahmad said and that I said earlier, I agree with all of the panelists on everything they've said on this question. 2 things that make just life so much better and so much easier are virality and net revenue retention. So, virality, is there a network effect? Is there an effect of, bringing on more? And then net revenue retention, if I'm the same customer this year at the beginning of the year and I buy 100, do I buy 150 on average by the end of the year? So, land and expand. Those things just make things so much better, I would say, from experience, on top of everything else.
All right, so here we're coming to the end of our time, and this can be a short answer, but it's going to be my left field question. So, and I've written a lot on this. That everything to do with climate change it's all being driven by the people we can't see, which is the poor. So there's 3 billion people who are low energy users. There's 3 billion people that are going to be born into that part of the world. You're going to get 6 billion new energy users. And if they reproduce what we're doing now, if you think you have problems, you will have massive problems in the future. So we all have now are saying EGS, but it's the part of the world we don't see. And it's not what our investment and financial sector set up for. Do we have any hope in the next 5 years for the investment sector to recognize that and really go to the root of the problem, which in my opinion is the poor? Yes or no?
Yeah, I mean, maybe I'll start off. I mean, because this is a very, very tough question, but I think the answer is yes, and maybe because I'm optimistic. But just like how the renewables are making a difference in the world faster than anyone thought, I think the same thing will happen. The people will start focusing on the S. I mean, one of the examples I'll give you of a client we're working on with right now, and they're next week or week after that, hopefully announce a deal, as a solar developer that purposefully works with customers that have a credit score of below a certain number, 650, 700. And it sounds counterintuitive, but those people with that type of credit are actually really good at paying their bills, because power is something that they actually pay the bills on time. And companies are coming up that are bold enough to target that segment, right? And just think about it from an economic perspective, it makes all the sense in the world, because every other company is chasing the 750 plus credit scores, right? And there's a ton of competition, but people are not, companies are not really activating. So that's an idea that gives you an idea, of that S part becoming important. And another thing I also say is that Microsoft, so there's there's a corporate PPAs essentially. I don't know how many people on this call are familiar with it, but in order for a wind farm or a solar farm, or I guess any renewable tech, to be financeable, to attract capital and actually get built, you need some sort of cash flow stability, which historically was provided by the large utilities giving out offtake agreements 15, 20 years. But more and more, if you look at last year, a lot of these contracts were actually provided by corporations like Microsoft, Facebook, Amazon, and so on and so forth, that do have ESG for, in their, they want to green the world, right? They want to take off their carbon footprint. And Microsoft recently announced a deal with another one of our clients that we were working with, a solar developer, that the project they will build, a piece of the revenue will actually go to the communities where that solar farm was built. And a lot of the time, these solar farms are not built in Manhattan, right? I mean, they're built out in the middle of nowhere, where those areas can benefit a lot, from that project being put in place. And so it's starting to happen. We're in very early stages, but I do have hope that the S will become more and more.
Well, yeah, I think Brandon's here. We need to end, but I think the unmet challenges for places like the continent of Africa, Indonesia, and somehow my Aladdin wish would be that would get incorporated into ESG strategies, because until you take care of the poor, you're not, and I'm talking about the global poor, you're not going to have a sustainable planet. So that's my Aladdin wish. And to answer Dan's question, I think that's there's an unmet challenge there, and it's a huge opportunity. So, all right, Brandon, I think we need to wrap up. Is that correct?
Yes, I just wanted to say thank you so much, Professor Nocera, Dan, Kelly, Ahmad. This was great. For all of our viewers, we will be having closing remarks with Aaron Blanton from the Columbia Center on Global Energy Policy on the main stage for the next 10 minutes or so. And thank you for attending.
Okay, thank you.
Thanks, everyone.
Thank you. Thanks, everyone.
Thanks, everyone. Thank you for having me.